$10 trillion under management. A single firm quietly becomes a top shareholder in Apple, Microsoft, and thousands of others, wielding proxy power that can sway entire markets. Behind the scenes, it builds the financial infrastructure governments now depend on in a crisis. The official story calls this efficiency. But how did BlackRock's rise grant it real control over the world's money, and what does that mean for the rest of us? In 1988, a small team led by Larry Fink launched a new asset management firm in New York. Fink, shaped by a costly lesson at First Boston 2 years earlier, built BlackRock around a single obsession: understanding risk. The company's early years focused on fixed income, offering institutional clients something rare at the time: sophisticated risk analytics that could track exposures across sprawling portfolios. By 1994, after splitting from its original parent, BlackRock managed $53 billion in assets. Going public in 1999, the firm's reach expanded rapidly, fueled by its proprietary risk platform and a reputation for caution in volatile markets. But the real inflection point arrived in 2009. In the middle of the global financial crisis, BlackRock acquired Barclays Global Investors, including the iShares exchange-traded fund business, for $13.5 billion. Practically overnight, the firm's assets under management jumped from about $1.4 trillion to $3.3 trillion. With the iShares acquisition, BlackRock became the dominant force in exchange-traded funds, a new breed of investment fund that allowed millions of people to buy broad slices of the market with a single click. This shift toward passive investing brought a flood of new money, swelling BlackRock's scale and cementing its presence in nearly every corner of global finance. By the end of the decade, BlackRock's size was unprecedented. Its risk-centric culture, combined with the explosive growth of exchange-traded funds, laid the foundation for a new kind of financial power, one built not on direct control, but on quiet, systemic influence stretching across thousands of public companies. Larry Fink's vision had created a firm whose reach would soon touch nearly every part of the world's economy. BlackRock's scale is not just a number, it is a seat at the table in boardrooms across the world. Quarterly filings with the SEC show BlackRock holding 7.3% of Apple and 6.8% of Microsoft, translating to hundreds of millions of shares in each. These stakes make BlackRock a top 10 shareholder in more than 5,000 public companies, a position that comes with the right to vote on everything from executive pay to climate policies. Every spring, when annual shareholder meetings take place, BlackRock casts votes on thousands of proposals, representing roughly 18% of all S&P 500 shares. Its stewardship team reviews board elections, mergers, and shareholder resolutions, shaping outcomes at the world's largest firms. This voting power is exercised on behalf of clients, yet the practical effect is concentrated influence. Academic research, like the 2018 study by Azar, Schmaltz, and Teku, argues that shared ownership among giants like BlackRock can soften competition. In industries where BlackRock is a major investor in rival companies, prices can rise, not because of any secret deal, but because incentives quietly align. The same study found that airline ticket prices increased by up to 10% when common ownership was high. Supporters say BlackRock is simply a steward for millions of savers, following a fiduciary duty to maximize returns. Critics warn that this hidden hand can sway markets and corporate behavior in ways that are hard to track. With so many votes to cast, the question becomes, how does one firm keep track of its influence across thousands of companies, each with its own challenges and risks? Aladdin is the engine room of modern finance, quietly running beneath the surface of global markets. Developed by BlackRock, this platform processes more than $20 trillion in assets, an amount that dwarfs the GDP of most countries. Aladdin does not just serve BlackRock, it is licensed by hundreds of clients, including some of the world's largest pension funds, insurers, and even rival asset managers. Every day, Aladdin ingests a flood of market data, trades, and portfolio positions from across the financial world, analyzing risks and exposures in real time. The system acts as the financial plumbing that connects investment decisions, compliance checks, and risk controls across thousands of portfolios. For many institutions, Aladdin is not just a tool, it is the backbone of their operations, shaping how money moves and how risks are managed. The platform's reach gives BlackRock an unparalleled window into the flows of capital, letting it see patterns and vulnerabilities that others might miss. In a world where information is power, Aladdin's data flows make that power tangible. In the aftermath of the 2008 financial crisis, BlackRock shifted from managing private portfolios to handling the fallout of public disasters. When Bear Stearns collapsed, the U.S. Treasury called on BlackRock to oversee billions of dollars in distressed assets, trusting its risk expertise to untangle some of the most toxic securities on the market. The firm's mandate soon expanded to AIG, where it managed complex portfolios on behalf of the government during the insurer's bailout. Across the Atlantic, British authorities tapped BlackRock to advise on the management of failed banks' holdings, including the winding down of mortgage assets. These contracts, awarded between 2008 and 2012, placed BlackRock at the center of crisis response, often with little formal competition. Watchdog groups and some lawmakers raised concerns about conflicts, warning that a private asset manager overseeing public money could blur the line between market participant and market referee. Still, the government's reliance on BlackRock set a precedent, establishing the firm as the go-to problem solver for financial emergencies. On March 25, 2020, as global markets reeled from the first wave of the COVID-19 pandemic, the Federal Reserve handed BlackRock a contract unlike any before. With no competitive bidding, BlackRock was tapped to manage the Federal Reserve's emergency bond buying program, known as the Secondary Market Corporate Credit Facility. The agreement gave BlackRock direct authority to purchase billions of dollars in corporate bonds and exchange-traded funds, or ETFs, acting as the operational arm of the central bank in stabilizing credit markets. The fee structure paid BlackRock a fixed monthly retainer, plus a small percentage of assets managed, all detailed in public vendor agreements posted by the New York Fed. Senator Elizabeth Warren called it crony capitalism at its worst, questioning why the Federal Reserve had turned once again to its favorite contractor from 2008 without any competition. Lawmakers from both parties raised concerns about conflicts of interest, pointing out that BlackRock managed money for many of the same corporations whose bonds it was now buying on behalf of the government. The Inspector General's later review found no evidence of abuse, but critics argued that the line between public policy and private profit had grown dangerously thin. In Maricopa County, Arizona, property records tell a story of rapid change. Between 2012 and 2023, more than 1,000 homes were bought by entities linked to BlackRock, according to local deed filings. These transactions often involved bulk purchases, with dozens of houses changing hands in a single day. Academic studies and county data show that during this period, average rents in Phoenix rose by nearly 20%. Neighborhoods that once offered affordable options for first-time buyers saw inventory shrink and prices climb. Researchers have tracked a direct correlation. As institutional ownership increased, so did rents, outpacing wage growth for many local residents. The numbers are clear. What happens on spreadsheets and Indeed offices has a direct impact on the streets where families live. These records provide a concrete link between Wall Street's reach and the cost of everyday life. For tenants in Phoenix, the numbers on property records translate into real consequences. In the Maryvale neighborhood, one renter described how her monthly rent jumped from $1,200 to $1,500 within a year after her building changed hands to a corporate landlord. Local council meetings grew heated as residents pressed for rules on ownership disclosures and caps on bulk purchases. In response to growing scrutiny, a BlackRock spokesperson said they invest on behalf of pension funds and everyday savers and do not directly manage or control the properties in question. City officials debated proposals to require transparency from institutional buyers, but faced pushback from industry groups. For families caught between rising rents and shrinking options, the debate over who owns their home is more than a policy question. It is a matter of stability and belonging. Today, a single firm's algorithms can shape markets, policies, even the price of a home. As financial infrastructure becomes public infrastructure, the lines blur between private interest and public consequence. The future of power isn't decided in parliaments. It's coded in systems most never see. What do you think?